people have been complaining that the stock market's not the economy and the economy is not the stock market. I think what's happening is the stock market is adequately reflecting the rapid and increased pace of change we're seeing in the composition of economic activity. So to put it more simply, those companies that are, and you could view this perversely or not, that are benefiting from shelter in place, stay at home, have clearly outperformed. Those that are losing have been left behind. And as Bob Pisani was saying earlier, those winners happen to be among the big mega cap stocks in technology, biotechnology, and elsewhere. They're driving the market higher. Both those index groups are in the plus column for the year. So I think that, the market at one point reflected the expected weakness that we're now seeing. The bond market's sending a completely different story, we might add, that, the possibility of negative interest rates, low short-term rates reflecting weakness in the economy. Stocks are reorienting towards what the economy will look like on the other side of this, not necessarily the fact that we have a V-shaped recovery in our future.
So is that reorientation, Ron, in your view, already reflected in valuations, particularly you mentioned technology. We're positive on the year here. We've gone up very fast in these sectors.
Well, if it's a secular shift and we're digitizing the economy more rapidly and using communication services on a more permanent basis, we're going to the office fewer days a week, we're having more home deliveries. This could be something that's just been accelerated by the coronavirus and the associated activities around it. That could be a long-term phenomenon and maybe not fully reflected in the price of these shares. On the other hand, you're seeing the bond market worry about the weakness in the macro economy. And so while it's a tale of two markets, they both may be saying the same thing. Those companies that are being left behind are being decimated in the stock market, or in case of retailers declaring bankruptcy, those that are going to win in the long run continue to move higher.
David, is there value in this market right now, given the lack of clarity?
There definitely is value. There's not as much as there was a month ago. A month ago, you could throw a dart at a wall, and short of getting into the airlines or the restaurants, you were going to make money in them. You've just had a great rally, and technology has led that rally. So there are places that are in value, which we think are some of those technology stocks that are at 30 and 40 and 50 times earnings. But there are also a lot of stocks that are selling at 12 times earnings, paying very healthy yields that are not that impacted by what's going on. So we think you can buy those even though you have a miserable economy, as long as you have a 12-month outlook. Companies like CVS just had a very good quarter, Duke Energy, Kellogg doing very well, AT&T doing very well. You're getting a 3+ yield on all of them. They're selling under 12 times earnings. The businesses are doing quite well. But because there's no sizzle, the stocks haven't done a heck of a lot. And that's where we think you want to try to navigate this very uncertain environment.
We were just talking to Steve Leisman and Tom Gimbel about a potential second wave of unemployment. David, I'm wondering if that is a concern, because even for those stocks that you mentioned that are pretty immune to what's going on right now, another wave they might not be immune to. CBS and AT&T now with more media assets is more exposed to ad revenues, let's say.
More exposed than they had been, but not that exposed. And at some point during every recession, there's a tremendous disconnect between the dismal economic numbers and the stock market. So we think that the stock market, if there's any sort of light at the end of the tunnel in terms of the health side and treating COVID or a vaccine, is going to look toward 2021. And in that case, it's going to really look beyond what's happening in the current quarter or 6 months, even if there's a second wave or uptick in unemployment. And what's for sure with the companies that I just listed is they are going to be around. They've got really good balance sheets. They've got really good cash flow, and you're not paying a lot for them. So even if there's a second wave, these stocks should very likely be higher 12 months out.